Industrial investment volumes reached the third highest recorded volumes in 2011, which was unexpected considering the economic and in particular the lack of debt finance in the markets we've seen across Europe. Most notably, though, we saw during 2011 that a majority of the transactions took place during the second half of 2011. This is on the back of the high occupational demand which we saw during 2011, whereby occupier take-up reached record levels of over 16 million square metres across Europe. Well, we certainly expect to see the strength of investor demand continue into 2012 from 2011, in particular in the core Western markets such as the United Kingdom, France and Germany, which is driven by more economic stability and also the availability of debt for these types of transactions. The Benelux region saw accelerating activity in 2011. We certainly expect that to continue during 2012. As a natural extension to the core markets of the United Kingdom, France and Germany. However, it is a small market, so the issue will be whether there's enough availability of product being brought to the market to please the investor demand, which is there seeking certainly core assets in those markets. Other markets which would be of interest to investors are certainly the CEE region and also Russia. Poland in particular has got strong demand from investors on the back of the strong economic forecast predicted for that country, and the only risk there in that country is the availability of land, so location is a key driver for investors in this country. Russia will remain on investors' radar screen as it becomes a maturer market. There are a lot of risks attached to the region, however that is reflected in pricing and opportunity for investors, and also that's where a region where we think we will see some capital growth take place. Well, interest in the Nordic markets is expected to continue to remain strong during 2012. The main issue is, though, the occupier demand is relatively stable but quite low, and therefore we don't actually see too much new product being built and brought to the market to relieve the investor demand, certainly for core investments in those markets. Therefore, we think that this will certainly have an impact on the transactional volumes during 2012, which we did actually see during 2011 as well, and may actually decline further due to the lack of availability of product in the markets during this year. Overall, I expect we'll continue to see investors focusing on the core Western markets, still the UK being the main driver, closely followed by Germany, and then France. It will in particular depend on the availability of product being brought to the market, the type of product, and also the availability of debt still being a big driver as to whether transactions can take place or not. Very much so. Industrial assets attracted significant cross-border activity in 2011, in part driven by an increase in international investment across Europe, of which 40% of the transactional volume was from international investment, and over 50% of that was invested in the UK market, closely followed by Germany and France and the Netherlands. However, during 2012 we certainly expect this to continue, but we expect that there'll be a more rebalanced positioning of transactional volumes across Europe, in particular in France and Germany, where we see greater portfolio transactions happening as those international investors look to rebalance their portfolio from their significant investments in the UK during 2011. Well, last year capital growth was led by the CE and Russian regions, which was driven by yield compression in addition to rental growth in comparison to the core European markets. However, we do expect the pace of the yield compression certainly to soften, although in some selected markets we expect to see further yield compression during 2012, again driven by the CE and Russian markets, but perhaps also in those core locations in Germany and France, and perhaps in the UK as well. Due to economic headwinds, though, and also the lack of debt availability in certain non-core European markets, such as Spain, Italy, Hungary, Romania, perhaps also in the Netherlands, where investors see the economic stability as certainly unattractive for their investors, we do expect to see a slight softening of yields, which we've already witnessed in the Milan and Barcelona markets.